Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next, let's say, 25 minutes today on Options Guide TV. All right. Well, we on Wednesday had a little bit of an issue with the SPX trade that we put on Monday. So we got to talk about the good and the bad. The market has rallied, ran up, ran back down, ran back up again. A lot of volatility in the marketplace. We're actually seeing the VIX down a little bit at this point in time. It's trading at 1562. And we have a big day on Monday, and that it's Martin Luther King Day, so the markets will be closed on Monday. Also have the changing of the guard. We'll have the inauguration on Monday. We got into a long IWM straddle. The market really hasn't done too much. IWM is up a little bit today. The whole market is up quite a bit. IWM right now is up about 0.5%, trading at 225.88. But more importantly, the SPX is up a percent, trading at 6,000 once again. The actual volatility of the SPX has been quite busy, I should say, recently. We're seeing about 1 to 1.5% moves on a daily basis in the SPX. But right now, we're still seeing the VIX index, which is based off of the options in the SPX, because the market is up, has came back down a little bit. So that's going to be my theme. I do think that we're going to have more volatility after the inauguration, after the change in the guard. There's going to be a lot of headlines that are going to hit the marketplace, a lot of uncertainty, a lot of euphoria about potential policies, but let's see what the real policies are. We're talking about tariffs with our brother from another mother, Canada, and that could be inflationary. But we had a good solid CPI report. Economy seems strong. We got good jobs. So I just think over the next month, there's going to be a lot of headlines that will hit the marketplace and will create some volatility. So the fact that the VIX is trading down around on the lower end of the range, right around that 15% level, I'm going to do a very speculative trade, not for the faint of heart, today in the VIX index. And I'm going to go out to the February expiration, which is 33 days away. Now, if I look at that expiration, the VIX isn't trading where the spot index is right now. It's still fairly low, I think. I think that there's some potential there. And if that statement confuses you, you want to go to an article that I've written. I guess it's not recently, but within the last, I guess, month or so, heading into the Christmas holiday, on the VIX index, decoding the VIX. It's in my profile at Brian Overby on X.com, and it talks about how the VIX index really tracks the future. The options on the VIX index track the futures contract, and they do not really track the actual index and the rationale that's behind it. But more importantly, if you want to know where the VIX index is at, here's how you do it. Quite simply, and it's going to be very easy here because the options are trading at almost the same price. If you look at the February expiration, and I've mentioned this a couple of times on Options Guide TV, I do not like trading the weeklies. They just are too illiquid for me. But there still remains good open interest and good volume. And you can actually see it here on the open interest inside the Tradier Pro option chains. You got open interest 21,000, 114, 100. We have solid open interest on any strikes that are around where the VIX index is at right now. Also decent volumes. Okay. So I'm focusing on the 16 strike. It's being highlighted because this is where, well, I guess I can point up here. This is where the VIX is at right now, 1564. It's down 96 cents on the day, about 6%. That doesn't necessarily matter. The fact that it's below 16, I think, matters to me. But if I look at the February contract, I'm going to highlight here in the Tradier Pro software that we are looking at the February contract. And we just go down and look at the chains. Go over here. You see that the call option on the 17 strike is trading for 164. And if we look at the ask on the 17 strike put, is trading for 167. So bottom line is the futures contract for the February 19th expiration is trading somewhere around 17. And this is important because I'm going to trade the February 19th expiration. So I do anticipate that we could have some volatility. On the 29th, we have a Fed meeting, and that's going to be a very big Fed meeting. Highly anticipated that they're not going to do anything as far as cutting rates. Right now, the Fed funds futures say that there's basically zero chance of that happening, of a rate cut. And so it's going to be more about the statements as we head into that. We have the Treasury Secretary being sworn, well, I should say interviewed right now to be appointed. And a lot of comments are coming out of that session of Congress. And then, oh my gosh, it's hard. The tariffs, all the policies, there's just going to be a lot of news headlines that are going to blindside the market. Don't know if the market's going to accept them and go up or go down, but I just think that volatility is going to increase. Okay, so the 17 strike is trading for 160. I want to own this. It's 163 by 160, obviously a decent market. I am going to speculate that the VIX will not go down below the 15 level. It's very hard, and later I'll pull up a chart on the VIX, but it's very hard for the VIX to break below that level. It's very possible, but it's hard, I think, in this type of marketplace for the VIX to break below that level. So I am going to sell a put spread to pay for a call. Once again, a very speculative trade. But there's nothing wrong with doing this trade, right? You're going to have limited known risk if you put it on. I just don't want to pay on a $16 option contract. I do not want to pay the pumped up implied volatility. The VIX, the VIX of the VIX, is trading at around 100, which isn't bad. It's not on the high end of the range, but it's medium. And I just don't want to pay that much for a $16 underlying right now, or $17 actually is what we just proved by looking at the price of the call and the price of the put. Now, if the call option was trading for more and the put was a little bit less, well, then you would say that the call option is more in the money and it would be a little bit higher than 17. If it was the opposite, then it would be a little bit lower than 17. But you want to see, when you're trying to figure out where the futures contract is trading, is where do these line up? And just look at ask to ask or bid to bid. And 163 is the ask here and 167 in the ask here. So bottom line is that futures trading very close to $17. And you notice that if you look at the 16 strike, just to prove my point one step further, 1560 is where the market is at, the most at the money strike for the actual spot index, which does matter at expiration, where the VIX is at. Eventually, in all futures, it starts where you have a futures contract and it's got to morph into the actual spot price. So in the futures marketplace, the actual VIX index would be called the spot. And if that is the case, you notice that, by the way, this strike call option should be out of the money. But in this instance, it's showing that it's trading for $2 and the put is trading for $1. All right. So that is showing you that in this instance, the put is more than the call, but according to the spot, right, the call should be out of the money and the put should be in the money. So the put should trade more than the call. But that's not the case. Okay, so that's my little lesson. If you want to learn more, please go to @BrianOverB on X.com and read the article called Decoding the VIX. Let's put the trade on. So I'm going to, if you have any questions about this, because this is a complex thing, and if you haven't ever traded VIX options, I definitely recommend doing it on paper. And if you want to follow the trade along, just make sure that you're, I wouldn't want you to I don't want you to get surprised by the action in the VIX. So if it's your first time ever trading a VIX option, just watch it. Don't dip your toe in the water just yet. Okay, so the put, which is out of the money by a couple of points right now, is trading for 49 by 50. So my put spread that I'm going to do to help pay for my call is I am going to sell the 15 strike put. Let's get rid of this. And then I'm going to hedge myself by buying the 13.50. Now I can go down to the 13. That's 5 cents more. 5 cents less. Save me a nickel for 50 cents. I don't think so. I think $1.50 of risk is what I'll have. I'm going to put this on here, and I'm going to bring in 40 cents. A 40-cent net credit with the futures contract at 17, have $1.50 of risk. Minus the 40-cent net credit means my total risk is $1.10. Now, on the upside, I'm going to come out and I'm going to buy the at the money strike. I'm going to buy the 164, 161 bid ask on the 17 strike. And if I buy that, I can do this all as one trade if I'd like. I'm going to reduce my cost from 164 minus that net credit of $1.22. Okay, so if you want to do the total risk of this trade, what we're talking about here is we have $1.50, and that's going to be a margin requirement. That's going to be held out because we're short a put spread. And then we're going to pay $1.64, but we're bringing in a net credit of 60 cents. So the total risk would be this debit, which is 122. Oh, actually, yeah, and that includes the short put spread. So we have $1.22 net debit that we have to pay to get into the trade, and we're going to have $1.50 margin requirement. So that means that we're going to have $2.77 worth of risk. And if we do this trade and we put this trade on, we're not going to ride it all the way to the end. So we're not looking, usually you're going to get a little bit of vol premium. We're just hoping that there is some shock to the market, which, is a sad thing to say, but that there's some shock to the market that allows us to sell this call at a much higher price than where it's currently trading. And if that happens, well, then this put spread will eventually go out worthless, right? If I can buy this back for a nickel, I'm going to do it at any point in time between now and then. And that's feasible. If we got to run up to 21, 22, 23, possible we could buy this thing back for a nickel, but we're going to take that risk off. But ideally, this is a trade that we're going to put on. If we see the VIX index drift down towards the 13 level, well, we'll probably just sell this call. But we have 33 days, a new administration, headlines hitting the marketplace. I think there might be something that shocks the market. That is to go along with our IWM trade, which is a long straddle, which is looking for something to shock the market. So these are two trades. These are two different versions of the trade. Don't go heavy on it. It's a very speculative trade doing this on the VIX. Now, I'm going to toss out one other trade, mainly because this is going to be my official paper trade. If I was going to do one of the two trades, I think I would do this more so on Charles Schwab. The banks have done well. Talked about the financials, did a trade on Goldman Sachs that did well, actually, after earnings. We got saved by earnings, but they were one of the companies that performed well. JP Morgan started it off. Always been more positive on the investment banking side of things, only because I think there's going to be a freeing up of mergers and acquisitions. There's going to be more people talking about deals than ever, and that's part of the new administration thing that people have been discussing, that less regulation, more ability to do deals. And so I think Charles Schwab, especially with the market volatility recently, the amount of volumes of trade, Schwab has also got a bank. They have Schwab Bank, and they have a brokerage firm, and they have asset management and a boatload of funds. So Schwab is a solid company that's in that space, still trading at a decent price to earnings ratio. And just like a lot of the financials, they're all priced. That sector is priced pretty well accordingly when compared to the other stocks on the S&P 500 index, in particular the MEG 7. So we're going to look at a long call spread in Schwab going into earnings. All right. So let me send this to the what if calculator first off, so that we can come back and look at that trade a little bit. And then I'm going to grab the Schwab long call vertical spread. And we're going to send this to the ticket, to the trade ticket. And let's go in here and pull up the chain on Schwab. So this is a speculative trade also, because obviously we're doing something around earnings. Market is not open on Monday. Schwab is announcing earnings before the open on Tuesday. The expected move, if we look at where Schwab is at right now, it's up 50 cents at 76. So we want to look at what the at the money straddle is. So we'll start by doing that. we're going to look at buying the 76 strike and buying the 76 strike here. I'm going to clear all this out. Okay. Buy and buy. And we see that that's $4.20. All right. So that means that's the line in the sand. This is what the marketplace is implying, is that if you buy the at the money straddle and you think that it's going to move more than anticipated, you would buy the straddle. You would buy the straddle. It's like looking at an over under on a football game in Vegas. Do you think the total points scored will be more than this level? Well, this level is what that long straddle is trading at, right? Or do you think it'll be less? And you can put a wager in on what do you think is going to happen? Are the teams going to score more points than this, or going to score less? And this is the one time where it really applies in the options trading world. All the monies are coming in, they're buying the calls, they're buying the puts, and they're basically saying that we think the marketplace could move after earnings going out to this expiration on the 24th around $4.21. So we just want to take what the marketplace is giving us, and we want to use that to set up our strategy. So I don't want to expect that the marketplace is going to do more than what the expected move is, right? Than the over under that is set. So I just keep that in mind. If I'm doing a long call spread, which is the trade we're going to look at, I don't want to do it 10 points wide, because the marketplace is saying that it's going to really struggle getting there. So we'll do 5 points wide. We'll take what they're giving us. And actually, we're going to go 4 points in our situation. Here's what we're going to look to do. We're going to use this information. We'll clear that out. We're going to buy a little bit in the money. The stock's at 76. We're going to buy the 75 strike call. And we're going to sell the 80. We're going to get this done for $2. So the risk reward is solid. We're going to pay $2 with the hope of making on a 5-point spread that we're going to make $5. So we're paying 2 to make 5. Or no, we're paying 2 with the potential to sell it for 5, making 3. That's a better way to say that. So 194, I guess we'll make that our price. And this is a 100% speculation on Schwab doing well, following the lead of the banks. Not every bank has done well. Bank of America actually announced earnings and they went down a little bit. But in general, a lot of the banks are doing better after earnings, and hinting that transactions are going up as far as the brokerage area. Recently in Schwab, there's been a lot of increases by analysts over the last month, thinking that their earnings are going to do better. So the whisper number has been a little bit higher. You worry about just like anything, you always worry about, buy the rumor, sell the news. It can always happen with earnings. They might come and blow the numbers out of the water, and people take that opportunity to sell the stock. So it's a very speculative trade, but this is going to be our paper trade. I don't mind this trade at all going into earnings. We got the market holiday on Monday. This is a solid trade to do next week. All right. If you have any questions, please feel free to put them in the chat box. And if not, I'm going to run back and look at the what if calculator. Let's go send this back up. And we will pull up the VIX trade. Okay, so here's the VIX trade. Now remember, the market is at 17. But here's what's up. We're buying this at the money option contract. We're paying less than, we're selling a put spread to help pay for it. Market goes up, we have unlimited upside. On the downside, between 17 and 15, not much happens. We do got the risk, got $1.22 of risk, which is our net debit in that range. But then if it goes down, we could lose another $1.50. So flatten out, unlimited, limited, and known. We get down below to 13.50, we have no more risk on the trade. So fairly inexpensive trade. I mean, it's expensive if you think that it's a $16 underlying. But our total risk was $2.77, $277 for every I guess it's 1 by 1 by 1 spread that we put on. We're going to sell one put, and buy one call. And we need a good name for this strategy is really what we need. But in this instance, there is no particular name that is out there. All right. I don't see any questions in the chat box. And the official paper trade, here it is. If you want to put that down, Yeah, go ahead. Then you can screenshot that. That's going to be the official paper trade. We're going to get a long call spread going into Schwab's earnings on Tuesday. And we'll see you this Monday. We'll have a show for Options Guide TV. We actually have, it'll be Education Monday. And we will cover inside that show, we'll go into detail about rolling covered calls. And then we'll come back on Wednesday and we'll see how this trade did. So make sure you tune in inside the Tradier Hub every Monday, Wednesday, and Friday at 11 a.m. Eastern Time for Options Guide TV. And we will see you this coming up Wednesday live inside the Hub. Hope to see you in the Hub.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.